Hey traders, I just came across something at the close of business here today, the close of market, that I thought I'd share with you on how to trade with an edge or how to find trades that have asymmetric opportunities. And it has to do with the billionaire David Einhorn. He is a hedge fund manager. He runs Greenlight Capital. He's a very successful investor. And it's a setup that he's putting together in Twitter stock. But it does refer to, looking for edges or asymmetric opportunities in the marketplace. There's no guarantees, obviously, in the market. We never know for sure if a trade is going to make money, but we can find opportunities that create an edge for us, or at least create an asymmetric opportunity. Probably the biggest asymmetric opportunity example that you hear over and over again in the market is that of Warren Buffett when he was a young man. And he put 40% of all of his assets in American Express. So if you don't know the story of the salad oil scandal, you can Google it. I won't take the time to go through it here. Just Google salad oil scandal of American Express. But if you read Warren Buffett's autobiography, you will understand that basically he credits this one solitary trade, putting 40% of all of his fund's assets into American Express, to launching basically him to where he is today. And it was about a 20-fold profit that he made on that trade. So there are opportunities here and there to have asymmetric risk where you're risking a very small amount and you have a huge potential payoff, or just simply trading with an edge where you have an opportunity to come out ahead rather than just blindly throwing your money in the marketplace. So I thought this was an interesting setup that I saw today with David Einhorn. He has reinvested back in Twitter shares, and his whole philosophy on this trade is that they basically took a stake at current prices of about $37 a share because they believe that the court is going to force Elon Musk to go through with his acquisition at $54 a share. So his basic premise is this. Look, we've basically got 15 bucks of upside with about 15 bucks of downside. So that's his calculation. He feels like Twitter's going to fall to somewhere around 22 bucks a share if the deal falls apart. So he says, look, we got 15 bucks of upside. We got 15 bucks of downside. It's a 50-50 risk reward ratio with about a 99.5% chance of success, meaning he feels like it's almost a guarantee. And that's kind of the consensus on the street as well, that the judge that is overseeing the trial that's being litigated between Twitter and Elon Musk is going to rule in favor of Twitter, that the law does seem to be in their favor, and that the acquisition will be pushed through. Whether it is or not, that obviously remains to be seen, but it's just another example of finding opportunities where you can invest with an edge or create an asymmetric advantage. So again, if you're not familiar with the whole Warren Buffett story on the salad oil scandal, that's a good Google, that's a good read. And this, again, I think is a good example of some really smart people putting trade ideas together where they do have an edge. Thought I'd like to share that with you. Hope it helps you guys in your trading. Hope you're having a good day. We'll talk to you soon.